In today's episode, I'm going to teach you the trading strategy I use to make over $319,000 on, you guessed it, GameStop. Over all my years as a trader and as an educator here on YouTube and at Warrior Trading, I've learned that success in trading comes down to two things. The first is having a strategy. Traders who don't have a strategy do not make it long term. You can make only so much money on beginner's luck and gambling before that luck runs out. So if you don't have a strategy, you cannot expect to be doing this for 5, 10, 15, 20 years with consistent results. Now, the second reason beginner traders fail is because they have a strategy, but they don't have the discipline to follow the rules. This is so important. In today's episode, I'm going to teach you the strategy I use. I'm also going to share with you some of the techniques that have helped me maintain discipline because let's face it, trading is difficult. It can be very emotional. The experience of having a very quick loss, a very quick gain, all of that triggers emotion, and it's not impossible to become victim of emotional hijack. When you become emotionally hijacked while you're trading, this is when things can get really bad. Fear and greed take over. Next thing you know, you're FOMOing into a position at the very top only to watch it dump. Was that following the rules of your strategy? No. What was I thinking? In those moments, you weren't thinking. You were totally emotionally hijacked. So I'm going to give you some tips to help you deal with that. Let's go ahead and jump into today's class. And I should probably mention, if I haven't already, that by the way, trading is risky. My results are not typical. I funded my first account with real money in 2001. So that was 23 years ago. And you shouldn't expect that by watching an episode like this, you're going to be able to make as much money as me. I've got a lot of experience. I've got a lot of educated intuition. But if you want to learn about the markets, I think it makes a lot of sense to learn from someone who has proven profitable. Now, you might find this interesting. My profits on GameStop, $319,000. Well, that actually accounts for less than 3% of my total gross profit that I've made in my career as a trader. $12.7 million right here. And the reason I haven't made more on GameStop, not to say I haven't done well on it, but the reason I haven't made more is because I have a very specific strategy and a very specific set of criteria for when I'm willing to take a trade. And there have been only a few times in the last several years when GameStop perfectly met all those criteria. On those days, in those moments, I step up to the plate, I take a big trade, and then I get out and I steer clear. I do not want to overstay my welcome. And you know what? Even today's trades are a good example of this. Today, you could see I traded 4 different stocks. 3 of them are red. I'm only green on 1 of them. But this is what success looks like because I cut my losses quickly. I had the discipline to recognize very quickly that these trades weren't working, but on the one trade that was working, I leaned in, I got aggressive, and I produced profit. $6,830.19 of net profit on the day after those losses. You can see that KAVL right now is actually the leading percentage gainer in the entire market. You'll understand by the end of this episode why I chose this stock, where I would have gotten in, and how I would have managed my risk. So let's go ahead and go full screen on today's class. We've got a lot to cover. All right, so this is how I made $319,000 on GameStop. You all know the chart on GameStop. I probably don't have to show it, but you could see it right there. It's a phenomenal chart, although it is definitely notable that the highs are always on what we call topping tails. The stock squeezes up and then comes back down. It squeezes up and comes back down. A topping tail is a bearish pattern because when we look right here and we watch this kind of, I'll annotate this for you the way it works. You have the price opens, it squeezes up, and then the bears bring it all the way back down. So when a candle closes like this, for instance, with a long topping tail, that is a bearish candle. Now, the inverse, if we have a candle, for instance, where we have a longer bottoming tail, that can be bullish, but that's not what we've seen on GameStop for the most part. We've seen large topping tails. Okay, so I'm going to walk you through the 5 steps of my trading strategy. Step 1 is finding the stock to trade using stock scanners. Step 2 is performing basic fundamental analysis. Step 3 is performing technical analysis. Step 4 is executing the trade. And step 5 is an analysis, a review of the metrics of the trade. But what I want to do first is I want to show you how the metrics of my trades actually summarize my trading strategy beautifully. So let's look at these metrics from GameStop. Okay, so these are all my trades on GameStop rolled up. So what I can do is I can search by symbol right here, and then I can have all of those trades filtered, and I can look at all of my metrics just based on GameStop trades. So what we have right here are a total of 245 individual trades. $319,000 of profit, as you can see here. My average daily gain from trading GameStop, $12,790. Average winners, 7,300. Average losers, 6,800. So from all of this, average hold time 7 minutes, you might not gain a whole lot. Let's look a little deeper. I want to look at the performance by relative volume. RV stands for relative volume. This, I think, is fascinating. So if you saw these metrics in someone else's trading, what would you recommend they do? Would you give any suggestion based on this data? I would tell them, double down on this and stop doing this. Right? That's what those metrics are saying. So, okay, let's better understand what this is a data chart of. This is showing my performance by the instrument's relative volume. Relative volume is a ratio that measures today's volume relative to what's normal for the stock. There can be different measurements for relative volume. Some people might use 7-day, 14-day, 30-day. It doesn't really matter. 7 days is a little too short. 14 days or 30 days is better. What this all means is that we compare today's volume to what is average for this stock over that 14-day or 30-day period. So if a stock trades with an average volume of, let's just say, 1 million shares a day, 1 million shares a day, that's the average relative volume. And then let's say today it's trading 1 million shares. What's the ratio? 1 to 1. It's 1. What if today it's trading 5 million shares? You've got a ratio of 5. Today's volume is 5 times higher than the average relative volume. What if we have 100 million shares? If we have 100 million shares, we've got a relative volume of 100. Now you might think that's crazy. You're never going to see relative volume of 100. Well, hold your horses. Let's just check here really quickly. KAVL, the stock I traded today, has a relative volume of 570. 570. Literally, this stock yesterday traded 644,000 shares of volume and today has nearly 50 million shares. That is a lot of volume, and that creates a huge spike in relative volume, which is exactly what I like. So this column right down here, or this row, is showing when the relative volume was between 300 and 500%. So that means it's between 3 times and 5 times relative volume, the average. They say 300 to 500, but it's just say 3 times to 5 times. And these days where I'm losing, this is very interesting. These are on the days where the relative volume is actually lower than average. It's only 25 to 50%, which average is 100%. So that means it's below average. And this is the day where it's basically right at average. So if we just take a couple of notes here, just based on the metrics, we should say relative volume should be a minimum of at least what? Well, I mean, I guess if we're just going to cut out the losers, at least 1.25. That's the minimum. So 1.25 minimum. But really, higher seems to be better, as we can see, because I did the best in the range of 3 to 5. But no reason to cut out winners down here in the 1.5 to 2 range. I mean, that's green, so that's okay. All right, so this is my performance by relative volume. Let's think for a second about what creates relative volume. Why would a stock trade with an average volume of 1 million shares and then today all of a sudden has 100 million shares of volume? It's a catalyst. It's some type of news. And this is the element where we do a little bit of fundamental analysis. We try to figure out, what is the catalyst? Why is this moving higher? If we could figure that out, then we're going to be empowered to be able to trade it and to understand why it's moving. Okay, so now let's look at our next data point. And this is, again, straight from my metrics. Performance by prior day's relative volume. Okay, so now this is measuring today just compared to yesterday. So what you'll notice is that I do the best when today is at least 2 times, if not 5 times or higher, better than yesterday. Now, this might seem like it's basically saying the same thing, but it's actually not. What this is showing is that I do the best when we have the most extreme change from yesterday basically being dead to today being really hot. And I don't do as well when I'm trading when yesterday was a big day and today is a little smaller relative to yesterday. So if yesterday's relative volume was really high and then today is lower relative to yesterday, that's when I don't do quite as well. So I actually do better when the extreme is larger. That, again, essentially means, the way I interpret that, and of course I know this to be true, is that I do better on day one of breaking news. What sometimes happens with companies, is that you'll have a company that puts out a news headline, and on day one, you have a huge green candle. And then on day two, and let's say this is on 10 million shares of volume, and then on day two, it continues to move higher, but it's on only 5 million shares of volume, right? Volume's kind of declining. This was the day with the news. That's when people are getting really excited. This is sort of what we would call a continuation day. Yes, it's still moving higher, but the volume is declining. Usually the move is smaller. And usually what happens is these candles get smaller and smaller and smaller until the price kind of reverses back down. So I try to be really careful over trading beyond the first day or two. I really like trading day one of breaking news right here. But after day one, we start to get into a range where it can be a little bit tricky. Okay, so this is my performance by prior day relative volume. Now we're going to look at my performance by percentage gain. So this is basically how I perform based on how much the stock has gone up or down today. Well, I suppose it shouldn't surprise you to see that all of my profit is when the stock goes up 10%, well over $400,000 of profit. But I obviously traded it on some of these days here where it was up less than 10% or it was actually down 10%. The reason that I might have taken a trade on a day when it was down was when day one makes a big move and then it sort of pulls back a little bit going into the close. And then it opens here on day two, down 10% on the day, but squeezes up. So it opens down and then moves higher. Now, of course, we also have the scenario of days where the price is actually just simply declining and I might have tried to take a bounce, but the price just kept going lower. And in those instances, I was trading against the trend. I always find that it's easier to trade with the trend rather than try to trade against the trend. Now we have another data table here. This is actually performance by the gap. And we see that very clearly I make the most money when the stock is gapping higher than the previous day's close. So again, a gap would be we close here and we open the next day here. So a minimum gap of 2% is where I'm obviously doing better, of 2% and higher. I actually know from my metrics looking more deeply that I do better when the gap is actually 10% and up. Because when you have a 10% gap and higher, this is where you've got generally a catalyst driving that momentum, and that's where we see usually some nice big green candles. So this is all painting a picture and giving you context of what works well for me. And what we're going to do is I'm going to take all of this data and I'm going to put it into a set of rules that I can share with you and that you can implement in your own trading. As always, I encourage you to practice in a simulator, especially when you're learning a new strategy, so you're not risking real money while you're still trying to figure out whether or not this will work for you. So the next data here is performance by time of day. And once again, I'd encourage you to give me feedback of if you looked at this data, what would you tell someone to do? Would you tell them to trade more in the afternoon or stop trading in the afternoon? I usually would say stop doing what's not working and do more of what is working. So more of this, less of this. So it looks like I've got a pretty hard cutoff at about 11 a.m. on GameStop. Why 11 and not noon? Honestly, it could just be from one really big loss that I took between 11 a.m. and noontime, because this isn't a huge set of data. The more data you have, the more confident you can feel in the conclusions that you draw. But certainly, this is generally fairly accurate across the board, that my profit gets bigger going into the open and then starts to sort of wane. And so this is where I really find that I do the best. It's in the hours, I don't usually trade as early as 4 a.m., although I did on GameStop a number of times. But generally between 7 a.m. and about 10 a.m. is sort of my window where I find the most success. And this right here is my cumulative profit loss on GameStop. And what's interesting here is that I started going in the red, but I rallied back into the green. gave back a bit, and then rallied back up, and then walked away, giving back a little bit off the top, but still nicely in the green and feeling pretty good. Okay, so now let's turn all of that into a set of rules, breaking it into 5 individual steps. Step 1 is to find a stock that is volatile. I don't make money buying something at 5 and selling it at 5. I want to buy something at 5 and sell it at, 6, 7, 8, 9, 10, et cetera, right? So step 1 is to find the biggest percentage gainers. Now, in this particular day here, we could see that NBTX was the leading gainer, up 225%, 39 million shares of volume, relative volume 7,342. That's an incredible move. And we can see on the chart here, this went from $2 all the way up to over $7, nearly $8 a share. So clearly a volatile stock. This is the type of thing that I love. I have just found that for me, I make the most money on stocks that are up more than 10%. And I generally have a goal of trying to capture, if I can, 10% of profit in one trade, which means I'm buying a stock at 5 and selling it at 5.50. If I can make 10% in one trade, I feel like that's a really good trade. So in order to make 10%, realistically, the stock probably needs to go up like 20%, because you're never going to get a perfect entry. So 20%, 30% or more, the bigger it goes up, the bigger I can get, a piece of that profit. But if it only goes up 3%, a sliver of a sliver is basically nothing. So I need relatively large moves in order to generate some, what I would feel like is some decent profit. So step 1 is finding the stocks. Now, I'm going to share with you the criteria that I use for stock selection. And I've programmed this into my scanners right here that I'm using. So each day, these scanners essentially are doing all the heavy lifting for me. They're searching for these stocks and then giving me the audio alerts. So I find them very quickly. So I'm looking for stocks that have 5 times relative volume. Generally speaking, that's my cutoff of where I do the best. GameStop has been a little bit of an exception to that, where I've got some great trades at 3 times relative volume, even 2 times or 1.25 times relative volume. That's not typical. The reason I think it works on GameStop is because when it starts moving, the moves can just be so big. And so I would say that this is sort of my note here. During volatile markets, higher price and float can sometimes be okay. Because GameStop does fall a little outside my typical sweet spot. The price tends to be a little higher. So going from the top, 5 times relative volume is what I prefer. Stock should already be up 10%. There should be a catalyst moving the stock higher. Most day traders do prefer stocks between 1 and 20. However, asterisk, if we have a stock like GameStop that's a meme stock and, really has a lot of momentum, then it's okay for me to trade it even if the price is a little higher. Now, each of these 4 characteristics indicate high levels of demand, right? And what we're essentially doing is, maybe without even realizing it, is we're coming back to that, sort of old relationship between supply and demand, right? So supply and demand. So demand is stocks up 10%, it has news, it's got tons of relative volume, traders like it. What is supply when it comes to the stock market? Supply is the number of shares available to trade. And so, as we know, GameStop back in 2020 had sold about 40 million shares onto the open market. Today, because they did a stock split and because they sold a ton of shares to raise like $3 billion, their float is now closer to 400 million shares. So that's a pretty high float. To be honest, higher float than I typically would trade, but GameStop is an exception. I have actually found that I usually do better when the float is under 10 million shares, under 20 million sort of is a hard cutoff for me in most cases, unless we have an exceptionally strong element of demand over here, like really good news. And of course, GameStop falls into this, but maybe a company that has just phenomenal news, a partnership with like Tesla or, something like that. Okay, so float of under 10 million shares is preferred. However, and if we look at the example today, You could see here KAVL. This one more closely fits in with what I would typically trade. Certainly up more than 10%. Price is great, under 20. Tons of volume, high relative volume. Float is quite low in this particular case. Okay, so we'll jump back over to the slides here. All right, so I take this data. This data goes into the scanners right here. And now these scanners are searching the market in real time for stocks that meet this criteria. Now, by the way, I will put a link in the description for a 2-week trial at Warrior Trading. If you want to try using these scanners, these charts, the news feed for 2 weeks and see whether or not it helps you in your trading. Now, during that 2-week trial, you'll also be able to tune into our chat room and listen to my broadcast and watch some of my classes. So you really get a sense of what it's like to be in our community. Over the last seven years, I've been building out this software right here. And my goal was to create what I thought would be the ultimate day trading dashboard. This place where you have everything you need in one platform. So this is something I've worked really hard on. And of course, all of our members are using it and enjoying it. So I hope you might consider giving it a try. Anyways, it's a 2-week trial. So try it if you'd like. Okay, so let's see. So now step 2 is figuring out what the news is. So once I've identified a stock on my scanners, I need to begin doing a little bit of due diligence. So I begin by looking at how much it's up on the day. I check the float. I check the relative volume. I check the price. I check the total volume. So I sort of go through each of these very visual columns. But then at a certain point, I'm asking myself, why is it up 200%? Right? It's kind of trying to figure out what is the reason that it's moving higher. And so what I do here is I actually pull up my stock quote window, and this is built into this software. So I pull up the stock quote window, and then I start searching for what's the catalyst. So GameStop, GME, you pull it up, and you'll see the latest headlines. Now, in some cases, we'll find that there's not a clear, obvious headline. You'll see the stock is just volatile. And we don't always know why that is. When that's the case, although I approach the stock with a little bit of caution, I'm still willing to trade it as long as the technical analysis supports an entry. So step 2 is trying to figure out the fundamental catalyst, why the stock is moving higher. Different types of news catalysts can include earnings, clinical trial results, FDA approvals, potentially new contracts, if it's like with a government agency or a small company doing a contract with NVIDIA or Apple or Tesla, something like that. And then we have some multiplying factors. Any kind of standard headline that also includes a current trend. It could be AI, it could be COVID, it could be NVIDIA or Tesla, electric cars, or a stock that fits into what's currently a hot sector. It could be pharmaceuticals, Chinese, AI, or if the stock is a recent IPO, a recent special acquisition company, or has a recent reverse split. These are sort of daily conditions. And when you have a stock that's a recent IPO and it starts to squeeze up, those can make really impressive moves. I just like, that's where we can get like some really nice juicy action that we typically wouldn't see on a stock that's been trading for a really long time. There's just something about the newness that I think gets traders sort of excited. Okay, so step 1, find the stock on the scanner. Step 2, fundamental analysis. Step 3, time for technical analysis. And I'm basically doing technical analysis all day long. I'm reading candlestick charts. This is where I'm looking for my entries. And this is where I've really found so much success in my career. So let's think about the way stocks trade for a moment. It is pretty much never the case that a stock just goes straight up like that. There might be days where a stock makes a big move, but if we zoom in even onto those individual days, what we'll find is that the stock generally is going like this. We have these waves up and back down, back up and back down, back up and back down, back up and back down. And these are the spots where I really get interested. Buying these pullbacks right here, which is a pullback off support, and riding the momentum up into the next leg higher. So one of the challenges that some beginner traders have is they'll say, well, wait, how do I know this is a pullback before I move higher and not just a, little dip before we go significantly lower? And that is a great question. I would say that there's a combination of things that you can do that will help you better identify the difference and differentiate the two. So one of the things that I'm always thinking about is trading a stock that's on what I call the front side of a move. The front side of a move is when the stock is moving higher and has not yet had its first kind of major pullback. So once you have a stock that's kind of gone like this, it's easy in hindsight to say, well, that right there marks the front side and the back side. But are there ways that we can know right here that something is shifting? And there are. There's a couple of different ways. So one thing that I look at very closely is the volume. So what we generally want to see is as the price is moving up, we have light volume. As the price pulls back, we have low volume. As it moves back up, we have even higher volume. As it moves back down, we have light volume. As it moves back up, we have higher volume. But if it moves back up and we have this divergence where we have lighter volume as it's moving higher, that divergence is something to pay close attention to. Declining volume shows that the trend is waning. It's getting exhausted, and that's when we're more likely to see a reversal. Now, one of the other things that I'll look at are the shapes of the individual candlesticks. If we start seeing more of those topping tails I mentioned earlier, those are weak. Those show weakness. The price is getting pushed back down. That's not something that we want to see. So if we see a lot of those topping tails, that also communicates the trend is getting exhausted. The further away the stock is from the volume weighted average price, which is a technical indicator, that extension represents higher levels of risk. Extension off of the 9 moving average is also considered higher risk. So pull back to the 9, pull back maybe around the 9, pull back way above the 9, that's higher risk of a false breakout. And then one of the third technical indicators that I use a lot in my trading is the MACD. MACD stands for Moving Average Convergence Divergence Indicator, and that tells us when the trend is getting exhausted. It measures the space between the moving averages. And so if we look at, we could look at KAVL here. So KAVL right here, and we'll pull this up. We'll go on to the, so you could see this is the MACD right down here. So this is where at the beginning of the move, the MACD has opened up right here, but right here it crosses over. So then we had a false breakout right in here. And these false breakouts are more likely when the MACD is crossed against the trade. But then look right here, the MACD curls. So with these with the moving average convergence divergence indicators measuring is that the moving averages here of the 9 and the 20 are moving apart. They're converging, sorry, they're diverging. And then right here, they're converging, they're coming together. And then they start pulling apart again because the price is beginning to rally up. So it's just a really great indicator for just kind of like gut check. Like, are we on the front side? Is the MACD open, or are we in an area of consolidation where the MACD is crossed? Because once the MACD is crossed, that's when trading gets difficult. And it's not to say that you can't make money trading potentially the backside after the MACD is crossed over, but it's more advanced to do that. So, you know, I was reading this interesting book. I'll show you this copy of it. It's Thinking in Bets right here by Annie Duke. She has 2 books that I like a lot, Thinking in Bets and Quit, The Power of Knowing When to Walk Away. But in Thinking in Bets, she talked about her brother teaching her how to play poker. And what she said is that he gave her a very specific kind of like list of these are the hands that you play. And she said, well, I've seen some other people playing hands that are outside your list. And he's like, yeah, okay, but you're a beginner. So these are the only hands you play. These are the ones that have the highest probability. So anything outside of that, you got to be more experienced. You need more intuition. That's for other people. Save that for later. So I would say similarly with trading against MACD, I find the most success trading when it's open. There are times where I'll trade when it's crossed, and I'll have some trades that, and some of them work well, but I know I'm taking more risk. So as a beginner, I think it makes more sense to focus on setups and times where you're going to have a higher probability of success. So now let's talk about, once you've done some basic technical analysis, so let's step back for a moment. So going back to why I started drawing this curve, the reason I did this was because I wanted to help you understand that we want to be buying off of these areas of pullback and off these areas of support. Now, to take that a step further, we're going to use our candlestick charts to help us identify these lower risk entries. I like to buy entries and take trades around $half and whole dollars. The reason is because there's a lot of psychological resistance that most stocks have as they approach these levels. So if we looked at a stock, and we could do this with really almost any stock, but what we would see is that, I'll just draw a line here, and we're going to do $3, $3.50, $4, $4.50, and then $5. What you would notice is that if we put all of the orders on the open order book, you would notice that not a lot of orders, and then lots of orders, not a lot of orders, lots of orders, not a lot of orders. Lots of orders get stacked up around $half and whole dollars. And so what that means is that as the stock is moving up and it approaches this area, there's going to be a lot of sellers. It's usually going to pull back for a moment. And if it can break through them because there's enough demand, then we move up to the next area where there's a zone of selling. And then we pull back for a second. We could break through that, then we move up to the next area. We pull back again. We break through that, we move up to the next area, we pull back again. And we can actually see this and visualize it as we're trading. We can see it very clearly on charts. We can see it on the level 2, which is the depth of market. And so once we know that stocks trade in this way, we know that we're going to be looking for these sort of pullbacks, and taking those entries off support and then looking for the next leg higher. So for the longest time, I've been trading around these $half and whole dollars because I find that once the stock breaks over those levels, that's when we see, these big moves. Now, there are times where we'll have a stock that is extremely strong, and I'll do what's called a micro pullback. A micro pullback is when the stock pops up just for a moment, dips down, and then surges higher, and I'm buying it right then and there. In fact, I think we probably had some good micro pullbacks on KAVL this morning. I'm going to look on the 10-second chart here, and we'll go back. So let's see. So as this was making its first move up, yeah, we had this nice one at 250 right here. So I actually took that trade right there. And we also had a nice one right here. So micro pullback, micro pullback, micro pullback. We call it a micro pullback because this is a 10-second chart. We look at that same pattern on the 1-minute chart, and all you see are basically like 6 green candles in a row, right? So on the 1 minute, you'd be like, I can't trade this. There's no pullback. But if you're actually looking at a 10-second chart, you would have seen there's an opportunity to buy right here at 250. You buy 10,000 shares at 250, it goes to 3, you're up $5,000, right? It goes to 350, you're up 10 grand. Goes higher, et cetera, et cetera. So these are the places that I often will look for my first trade to sort of break the ice on a stock that is clearly strong, is maybe pulling back just for a moment. And also, I think it's worth noting, this pullback right around 250, the $half, very common. Pullback here right around 350, pullback right around 4, right around 450. So this is, again, showing that sort of respect that this has to sort of the $half and whole dollars as the price moves higher. So that's all very common. Okay, so let's see. Now, one thing I also want to show you just for a moment. This is this shows you a market data view. It's showing you all the orders currently out on GameStop. But what I think is really interesting here is how it's showing you these horizontal lines are showing you where the orders are stacked. So the orders are stacked right here at 30, 30, 50. 31, not much at 31 here, but then 33. And then down here at 27, at 26, 25. These are big stacks of buy orders. Now, if we look at something like the S&P 500, the S&P 500 or, the IWM, the Russell 2000 index, these are going to have pretty high degrees of algorithmic trading. And the algorithmic trading is when you're going to have orders that are flashing. So you can see how this is sort of a really funny looking pattern here. You've got the orders, they kind of go away, and then they come back. And if you see right in here, it's kind of doing the same thing. These orders are kind of flickering around a little bit. So these are actually high frequency trading algorithms that are moving their orders around on the book in real time. Just testing orders, seeing if it causes responses by traders. And so one of the reasons that I avoid trying to day trade a lot of these stocks is because the algorithmic trading makes them incredibly difficult. These are computer systems. These are trading algorithms that are just moving the price around here, responding to orders that go through. But ultimately, these types of stocks are going to be very, very hard to day trade. Stocks like KAVL that have, clean price action, that's where I tend to find more success. And those are the days that I'd certainly be trading GameStop. This is another pattern that I like, buying the first and second pullback on dip trades. So then step 4 is my actual entry and exit, right? This is when I'm pulling up my trading platform and I'm actually going ahead and pressing the buy button, getting in, pressing the sell button, getting out. This is level 2. This is the depth of the market. It's pretty much the same as what I just showed you here, but it's in more numerical. So you see these numbers here. It's less visual, but it's still visual. But anyway, it's just different format. And we see all the orders going through the tape. Now, in order for me to proceed to step 4, I have to be confident I can manage my risk. So, you don't trade for 10 years or longer with consistency without having some degree of risk management. Risk management is something I take very seriously. So I am willing to risk $1,000 when I have the potential to make at least $1,000. But generally speaking, I don't even want to risk 1,000 unless this is my risk here, unless my reward is 2,000 or higher. The higher the reward is, right? 3,000, 5,000, 10,000, the easier it is for me to justify taking this risk. If I'm only going to stand to make $200, no way am I going to risk 1,000. That's just not a good idea. One of the problems is that a lot of beginner traders do exactly that. And I did too when I was getting started. The reason I did it was because I didn't understand these statistics and I allowed emotion to take over my trading. So what we know, just from a statistical point of view, is that if your average winners and losers are the same, you only need to be right 50% of the time to break even. But if your average losers are twice the size of your average winners, you need to be right 67% of the time to break even. And that's really hard, even for a seasoned trader. On the flip side, if your winners are twice the size of your losers, you only need to be right 33% of the time to break even. So getting yourself in this kind of area is really exciting because then you don't need high accuracy. You can get away with being very selective and just waiting for those good quality patterns. And then when they form, boom, you hit it, you get aggressive, and you can do well. So once I look at a pattern, and let's just say, for instance, we've got our standard bull flag pattern, which is going to be our first pullback. So we've got a couple green candles, could be 2, 3, whatever. We've got a couple pullback candles. First candle's getting ready to make a new high right here. Okay, so in this area right here, I'm getting zoomed in. This is the low. So that's my max loss. Max loss right there is the low of the pullback. So let's just say that's, $3, just for the sake of argument. And let's just say the entry here is $3.20. All right, so I'm risking then the difference between my entry and my max loss is 20 cents. Now, if I bought 1,000 shares of this, well, it's not dollars, 1,000 shares. If I bought 1,000 shares, I'd be risking $200. Now, some people would say, actually, Ross, you're risking 3,000, right? 1,000 shares times $3 a share is $3,000. You're right that I have $3,000 of equity, but I own a stock that has value. I own actual shares, real money. So I don't consider me to be risking that full amount. My risk is the difference between my entry and my max loss. So anyways, I guess I'm in that 3,200, but my max loss is if it's worth only 3,000. I take a $200 loss, I'm out of the trade. Now, if I'm going to risk 20 cents, I need the potential to make 40 cents. All right. So that's where we're looking for a move up to 360, ideally. Now, 360 is a fairly big move on a low price stock. So I might say in this case, is there a way I can get my stop a little tighter, like 10 cents? That way I'd only need to be able to make 20 instead of 40. But nonetheless, this is what I would be analyzing. And I'd be looking at the pattern, looking at the chart, and hoping that we can get that kind of squeeze higher. Now, ideally, we would get that. We get that squeeze higher. I take my profit going out as it goes higher, and then we wait for the next pullback to do this all over again. So let's talk about my very specific entry and exit indicators. Okay. So my entry indicators in green, my exit indicators in red. Okay, so when it comes to entries, I I need to see one of my preferred chart patterns. And I have dozens of chart patterns that I'll trade. I'm not going over all of those in today's class, but of course I have dozens of different patterns that I'm happy to trade, but I need to see one of the patterns I like. So it could be a micro pullback. It could be a first candle to make a new high. It could be an ABCD pattern, a red to green move. I mean, like I said, there's more than a dozen different patterns, but I need to see a chart pattern that I can sort of sink my teeth into. I feel good, and that I know that I can trade with consistency. That's really important. Number 2, I need to be able to understand my risk to reward ratio. Number 3, I check the level 2 and I look for possible resistance in the form of big sellers. So if I pull up this level 2 here, let's see, on KAVL, I don't see any big sellers on the level 2. What if we pull up GameStop? GameStop right now, I don't really see, I mean, you could see this one for 43. That's 4,300 shares, 4,300 shares. It's not a small order, but it's not a huge order either. If I saw a 100,000 share sell order, that's when I'm like, okay, we've got a big sell order. Now, here's the problem with seeing that. If you pull up the chart and the chart looks great, but then you pull up the level 2 and you see right here, there's a 500,000 share sell order, just for the sake of argument. Well, you're going to need a lot of demand to get through that level of supply. This creates a level of supply. So now the imbalance is higher on the supply side. It's probably not going to be able to break. It's probably going to drop back down. So this isn't going to work. So when I see a big seller like that on the level 2, I'll usually say, nah, I just got to steer clear and wait on this. It's not going to happen. All right, it's disappointing, but it's not the end of the world. As long as I don't see any big sellers like that, then I go ahead and I press the buy button. Now, for my strategy, I do something called, I use offsets. So let's see, we have a NASDAQ test symbol, ZVZZT. Sometimes the spread's really big though. Yeah, the spread's really big on this. Anyways, I could just do like whatever, well, Bank of America, just for the sake of argument. So if I take a trade on this, if I wanted to buy, let's say, 250,000 shares, and I wanted to buy at 39, 34, 35, I probably wouldn't fill the full order because there's not enough people selling shares at that price. Now, there's a lot of people selling, but probably not enough. So I would need to move my price up a couple of cents to accommodate slippage. And so that's what I end up doing on a lot of my orders. I type in my order entry window for the number of shares I want to buy, whatever it is. I move the price up a few cents, and then I click the buy button. I send my order. If I like the pattern, maybe I press that buy button twice, or I increase my share size to a bigger position. But that's how I usually am getting into a trade. Okay, so once I'm in a trade, what am I looking for? All right, well, I took an entry. That's great. Broke the ice, right? Obviously, I liked the pattern. I did my due diligence, checked the fundamental analysis, liked the my risk ratio on the trade, profit to loss ratio. Took the trade, pressed the buy button. Okay, now I'm in. I want to see the price move up immediately. And if I timed it right, if I truly have the right entry, then it will move up pretty quickly. I usually like to trade at levels that I think are like what I call an apex, where when the price breaks, it's going to move real fast. And so the thing I like about that is I call it breakout or bailout. It's usually like instant resolution. So let's see. Sorry. So it's like that instant resolution where it just basically rips. You don't have to wait for it. If you have to wait, then to me, that tells me that you didn't time it correctly. So in other words, my exit indicators, the price stops moving up or it slows. I don't want to see that. A topping tail forms or a doji pattern, I don't want to see that either. Big sellers on the tape, don't want to see that. Breakout or bailout, or if I hit my max loss, I got to get out of the trade. But basically, if I don't see any of the things I like seeing, then that by itself is an exit indicator. And I don't have to wait for the stock to hit my max loss if I see an exit indicator like a big seller. If I see a big seller, I could just jump right out of the trade, right? Why wait until it comes back down? It's already obvious what's going to happen. So as soon as I see that exit indicator, I try to get out. And that's something that I've gotten pretty good at. And I try to be ruthless about it and have like no qualms about just pressing that sell button and getting out. It's not a big deal. And if you look at my P&L today, I think this is a good reflection of just being brutal. Just cut the loss. Who cares? That stock is, it's dead to me. I've moved on. Now, look, if it comes back up, I'm happy to reconsider it. But if if it doesn't work at the time that I take the trade, then I'm out of that trade and I'm done. Now, my step 5 here is analyzing the metrics. And this is a really important step that a lot of beginner traders overlook. One of the things that I'm really fortunate for is that when I was getting started, I took it very seriously to track every single trade I took in Excel. So I took a ton of notes. The thing that was really good about this was when I hit that rough patch and I started struggling, once a little bit of beginner's luck ran out and I was losing money, I was able to go look at all those metrics and ask myself these questions. What time of day do I make the most money? What price stock do I make the most money on? What's the setup I'm trading the best? And from all of that, I was essentially able to filter out everything that I was losing on. And then what I was left with was things that were working. And I said, well, how about I just focus on this for a little while? So fortunately, you don't have to go through all of that necessarily. If you want to learn the strategy that I use every single day, you of course can do that. Again, there's a 2-week trial link down in the description. During that trial, you'll learn more about my strategy. You'll have PDFs you can print out, and you can use them in your trading as much as you'd like. But analyzing your metrics is really important because your metrics will help you fill the gap in understanding what you're doing that's working and what you're doing that's not working. Now, this is just an example of one of the trades on GameStop. This was a good trade. This was the entry. It was a little extended here. Thought that we were going into parabolic. It pulls back, but then it rallies back up. So like this would have been a great entry, a spot to be buying the dip right here. This would have been a great spot probably to be adding instead of selling. But nonetheless, these are solid trades, and it's based on this 5-step process. Finding a stock that's volatile and that's moving. Identifying the catalyst, checking your technical analysis and looking for your entry, of course, managing your risk with your entries and exits, knowing when to get out, not overstaying your welcome, setting a max loss, and then reviewing your metrics and constantly trying to improve and become a better trader. That's what it's all about. That's what this community is about. So, hey, I encourage you to join our 2-week trial at Warrior Trading. If you want to keep learning, we'd love to have you join us. I'll remind you, as always, that trading is risky. My results aren't typical. So manage your risk, take it slow. And if you enjoyed this episode, I hope you hit that thumbs up. I hope you subscribe to the channel, and I'll see you for the next upload real soon. Thanks as always for tuning in, and we'll see you soon.